Capital budgeting refers to the process of evaluating and selecting long-term investment projects or expenditures that involve significant cash outflows. It involves analyzing various investment opportunities to determine their financial viability and potential return on investment. There are several key steps involved in the capital budgeting process. Identification of potential investment projects. The first step is to identify and evaluate potential investment opportunities that align with the company's strategic objectives. This could include acquiring new assets, expanding existing facilities, or developing new products or services. Estimation of cash flows. Once potential projects have been identified, the next step is to estimate the cash inflows and outflows associated with each project over its expected lifespan. This involves forecasting future revenues, expenses, and any additional cash flows generated by the investment. Evaluation of cash flows. After estimating the cash flows, it is important to evaluate them using various financial techniques such as net present value (NPV), internal rate of return (IRR), and payback period. These methods help assess the profitability and financial feasibility of the investment projects. Consideration of risk and uncertainty. It is essential to consider the risk and uncertainty associated with each investment project. Factors such as market conditions, competition, and technological advancements can impact the project's success. Techniques such as sensitivity analysis and scenario analysis can help assess the potential impact of these factors on the project's financial performance. Selection and prioritization of projects. Based on the evaluation of cash flows and risk analysis, investment projects are ranked and prioritized. Projects with a higher potential return and lower risk are typically given preference. Monitoring and post-evaluation. Once a project is selected and implemented, it is important to monitor its performance and compare it to the projected outcomes. This allows for adjustments to be made if necessary and provides valuable insights for future capital budgeting decisions. Overall, capital budgeting is a critical process for businesses to allocate their financial resources effectively and make informed investment decisions. It helps ensure that resources are directed towards projects that generate maximum value and contribute to the company's long-term growth and profitability.